Mike Tedeschi, Wealth Management Advisor, Perspective of Planning, with this week's market breakdown video. We've been talking a lot about inflation, and one of the ways that we can take a look at whether this is going to be a consistent thing moving forward is actually inside gasoline prices. We're going to take an in-depth look at seasonality, where we are at, and what that could mean for us moving forward. As always, we'll also jump in, take a look at the 4 major U.S. indexes, some other commodities, and we are going to talk about some breadth readings here in today's video, because we are at, again, an important level that we want to pay attention to. So first and foremost, let's start with the S&P 500. As you guys can see, we've continued to notch new all-time highs. Market's kind of stalled out for the last 2 days. We're right at that 4,400 level that everybody's been talking about for a while. You know, that's that big round number, so we've got that law of big round numbers basically right here. When we take a look in at the Nasdaq, right, 15,000. We got just a tick or two above that. We'll see if we can continue to push above and hold over that 15,000 level. The Nasdaq's been incredibly strong from that breakout there in the middle of June, just kind of that straight up line. We jump in here and take a look at the Dow. We are right at that 35,000 level. That's really what I want to see here, is can we get that close over that 35,000, that big round number, and continue to push higher. That would be extremely bullish. The concern, of course, is what's going on in the Russell. We've talked about this a lot. This has gone nowhere, essentially, since a couple of days into the year. We're basically between that 2,100 level and that 2,350 level in on the Russell. And you can see it's just kind of been pinball action, up and down inside of this range. Well, we had the opportunity over a couple of weeks ago to try to make that breakout right here. It failed, and it actually took out the low from that 2240 zone, which was that spot in June where the Nasdaq actually made its breakout. Interestingly enough, we've continued to kind of head lower towards the bottom portion of this range. I would not be surprised to see us test that 2140 zone, that major level that has acted as support 3 or 4 times already this year. But the fact that we have such a divergence inside the Russell versus the other indexes, and the Russell being that mid-small cap area of the market where it can provide that risk-on environment, this is a bit concerning. We've seen some deterioration under the surfaces, and even though the major indexes themselves look really solid up near those highs, what's going on under the surface? Not as pretty. When we look at the S&P 500 breadth, right, we're looking at percentage of stocks above their 50-day moving average. When indexes are at all-time highs, you would expect that to be a very high percentage. We are below and right kind of at that 50% mark. That is historically extremely low based on the fact that we're up at those all-time highs. In fact, it's one of the greatest divergences that we have seen since the 1920s. I always talk about breadth and why it's so important, because it shows the overall health of the market. When lots of things are moving up together, that's a much better signal than only a couple of names. The major indexes become very top-weighted over the last few years, with a lot of the indexes in those really, really large companies. And those have been acting really, really strong as of late, breaking out to new highs, and they're carrying the indexes higher. But underneath the surface, we have not seen great action. We're seeing more and more names not making new highs, staying below their 50-day moving average, some even breaking down, and we've got the entire mid-cap section of the market kind of under a lot of pressure at this moment. So when we look historically, when the S&P 500 has made a new high in the last five times in the last 3 weeks, with less than 60% of the issues above their 50-day moving average, we don't get very many signals, but they are all very much consistently negative 6 months and a year out. The only positive actually was in 1998. Okay. Otherwise, we saw major negatives. We saw these kind of readings in the 1920s before the 1920s crash. We saw it in the 70s during the inflationary period, which is something I really like to pay attention to when I start seeing things with data sets similar to the 1970s based on the environment that we're in. And then, of course, we saw this again in 1999. We have not seen this in 20 years. So this is, again, there's not a ton of data points here, so it's not like, oh my goodness, the world is ending. But this is certainly an area for concern for us when we don't see participation across the board And we see data sets like this that show a year out, 17% of the time the market is positive. That is a very negatively skewed data set. So, as we continue to go through a lot of different data sets in these videos, you guys have seen a lot of this longer term stuff has been a little bit more concerning as of late than it has been in the past. Right? Doesn't matter until it matters. Indexes are still up at those highs. We still have to have that bullish slant, but in the back of our minds, we need to be thinking about some of these things. And if breadth continues to deteriorate underneath of the surface, then we might want to be a little bit more cautious moving forward. It hasn't necessarily happened yet, but we're certainly paying attention. Speaking of breadth, let's look at the Nasdaq. We have highlighted this a number of times. This 300 level has acted as a resistance zone there in that breadth reading of the Nasdaq McClellan Summation Index. We've turned back down. We're headed back towards that negative zone. We're at 18 and some change right here. You do not want to see us undercut May's low of that negative 300. Basically, in between the 300 and negative 300, we're kind of okay. Underneath of that zone is where really bad things happen, and that's kind of where we fell off a cliff back in 2020, right? So we're going to pay very close attention to this, but we're also starting to, again, see breadth reading issues kind of across the board, which is starting to be a little bit of a concern here. Now, let's jump in and let's talk about our commodities. First and foremost, let's look at the U.S. dollar. The U.S. dollar, nothing has changed on this chart. We know we look at this every single week, but we still have our lower highs, right? We had lower lows put in for a while, but now this actually could be a higher low. So really the pattern that we're in here over the last 8-10 months or so is this wedge. Whichever way this breaks, we want to be paying very close attention. And for me, we need to take out the highs from April if this is going to continue to head higher. And we need to take out the lows from the beginning of the year if this is going to head lower. In between, it's still kind of a mess. But we know with a stronger dollar here over the last couple of weeks, we've seen a bit of pressure in the commodity space. Right? Copper's still hanging on to that 410 level. Above 450 is really where we need to see it get to. When we take a look in at gold, gold actually got back up over that 1800 zone, starting to push back up. This chart's still a mess. We do have higher lows in, but we have lower highs in. So again, we need to see how this is ultimately going to resolve. As of the moment right now, it's again still kind of that messy range. Over 1900 really it gets very interesting, and for me the major level is still at 1960. Above 1960 I'm very excited about this space. Below 1960 I'm a little bit less excited. Silver still continuing to act better. As you can see here clearly, we still have a series of higher lows in place, and we kind of run into that wall up here around 29. How this pattern resolves, very, very important. A follow-through continuation would be extremely bullish. If we were to break down from here, that would change my whole outlook on the space. Platinum still held on to that 1,000 zone, back up over that 1,100 zone. 1,300 is the key in on that chart. We're nowhere near it at the moment. Not a whole lot to discuss there. Palladium fighting around that 2,800 level. That's really, really important, kind of all the way back to the support zone at about 2,700. Above that, still very, very bullish on this chart. Below 2,500, which is the major level that we can see played out here over the last year and a half, that becomes a very bearish setup there. We're nowhere near that. I still think this is the best performing precious metal in the space. We're going to continue to watch it very, very closely. Still looks very strong. Let's jump in now and let's talk about oil. We talked about this in depth, that we wanted to see a move back up into this zone. We talked about that 75 to 77 level for a long time, all the way in this run up in here. We hit that, and we now have turned back. We haven't broken down, so I'm going to zoom back in here so you can see a little bit more clearly, right? But we had a real trouble getting over this zone. Little spike high, immediate thrust back down. We still have a series of higher lows that are put in. The major key in here is going to be that 68 to 66 zone in terms of support. Underneath of that, that kind of changes the structure of this chart. Still extremely bullish. The reason why I really want to jump in and take a look at this, after we talk about oil, we need to talk about gasoline, and that's actually what we're going to do our other major analysis here for today. So I'm going to back the chart of gasoline out. I'm going to look at it on a monthly chart. We haven't paid too much attention to gasoline itself in these videos, so I want to give us that bigger kind of historical look, and I want to get clean, fresh lines on the chart for you guys. The major level is right in here, and that's at 240, and that kind of comes all the way back down into about right in here. This whole area is what I would call that resistance zone. You can see that from back in 2010. That's where we kind of slipped right through. You can see the failure in 15, you can see the failure in 18, and we're pushing right into that zone. Okay, this is not a clean breakout here until really we get back above this area a little over 240, and then our next area comes in at about 320. So this, just like the oil chart, is an area where it makes a lot of sense for us to run into some weakness. Okay, we've run right back up in a major, this is almost 10-year resistance zone at this point in time. We've done it after rallying and a huge percentage here over the last year. We'll go ahead and even just ignore the coronavirus bottom. We'll just take it from about the end of last year to where we are this year. Gasoline prices are up about 80%. Okay, if we go all the way from the low to where we are here, they're up about 450%. But realistically, if we disclude the coronavirus panic in here, this has still been a really great rise in 2021. After making a move of almost doubling and running into a major price resistance wall, it would make sense for us to turn back down. Now, the other thing that we're running into right here is some seasonality headwinds. I look at seasonality every once in a while. I don't put a ton of weight on it. The reason is it's very difficult to actually profit off of seasonality because it is looking at a period of time every single year. So if you were going to put a trade on based on seasonality, you would need to do it every single year for a decade or two in order for that edge ultimately to play out. But it is important to take a look at from a standpoint of this is the weaker season and this is the stronger season in something. The middle of the year, right around that July 12th marks kind of that high point for the average price of gasoline rising. And from there through the rest of the year, you can see you get a historic fall. Now, the reason why this is important is because we are in this environment where we're trying to figure out whether or not inflation is here to stay or if it's just temporary while the economy opens back up. And when we look at the price of gasoline in this portion of the year, it is a very difficult period for it to rise. We look at it from this way, right? From December to early July, gas prices go up. And from early July into late December, gas prices go down historically. All right. What happens here in the oil and gas market, I think, is very, very important in terms of telling us whether or not we have inflation that is here to stay. We're running into a major price resistance wall, all right, that has been in play for a couple of decades. We're running into the toughest time in the year for this particular space. If we're able to continue to push higher, that would be a very clear sign that inflation is here and it's probably here to stay for a lot longer than a lot of the economists are talking about. It's not going to be transitory. If we fail here and we start to roll over like we would expect based on seasonality and the fact that we're running into this price resistance zone, that would be a clear sign that this right in here might have just been transitory and maybe we're going to fall back into this range that we have been trading in for the last 7 or 8 years. Inflation pressures might cool. So this is what we want to pay very close attention to into the second half of the year, and I think it can help us make a lot of decisions in a lot of different markets based on what goes on here. As always, I hope you guys found this information helpful. If you want, you can reach out to me at mtedeschi at perspectivewealthplanning.com or pick up the phone and give me a call at 814-580-9881. I'd be more than happy to talk anything about the markets with you guys. As always, I will see you next week. Have yourself a fantastic one. Take care.